If you avoid those 4 mistakes that you will discover today, I truly believe that you can outperform the market for the long run, or at least have way better performance than what you have now. Plus, I also believe that if a market crash arrives in 2025, 2026, whenever, you will be well equipped to make profit from this market, and especially when it will start going up again. And after telling you the mistakes that you should avoid, I will give you a framework in 3 steps in bonus at the end of the videos that you should follow if you want to analyze great company and invest in great companies that have a chance to outperform the market for the long run. So the first mistake you need to avoid is to don't be a drama investor. Okay, what I call a drama investor is those investors that start to be emotional about the investment, start to believe so strong that they incarnate the company, that they became totally crazy. You can see them on YouTube easily. You have some companies that tend to attract those drama investors. The few ones that I noted are AMD, Uber, Nvidia, Tesla, Palantir. If you look at those companies, I invite you to type their Uber analysis on YouTube and AMD analysis on YouTube. First of all, it will be videos that tend to do more views than others. Second of all, it tends to also be company where people react way more. You will have way more comments in the comment section of each video. People will be reacting, and some will be reacting really, really dumbly. Okay, they will be really dumb, and you can see that they are totally emotionally attached to the company, and that's a big mistake. I'm not saying you shouldn't invest in those companies. Be careful. It's not what I'm saying. I'm saying don't be emotionally attached to those investments. For example, here on my YouTube channel, I posted like few videos for now. And the 2 where I have the most comments are AMD. Okay, I do an analysis on AMD, 30 comments. And another one, I do a kind of the same, an analysis on Uber, 26 comments. Okay, I have a little channel, so it's not a lot of comments, but compared to my other video when I will have 5, 10, 15 maximum comments, here I have twice much comment without having the biggest view on my channel. Like the one with biggest view is 4,000 views and it's 31 comments. For one which is have only half of those views on AMD, I have 30 comments. So that's why I'm saying that AMD is kind of a drama queen stock. So I'm not saying avoid AMD, I'm saying avoid being emotional on your investment. I think you never saw Warren Buffett being totally crazy and going everywhere saying you should buy Bank of America, stop buying JP Morgan because Bank of America is the best company ever, blah, blah, blah. Like never. So if you start feeling the need of commenting a video and being super emotional on AMD, Uber, or whatever stock it will be, I think it's a good sign that you should get out of this because you're too emotionally attached and your judgment is probably mistaken. You should probably make some mistake in it. You probably have some bias about it. So to avoid them, just get out and you will have plenty of other stocks. So it's not because you put some stock in the rubbish bin that you will never have any other opportunities. Okay? Second mistake that I see a lot is focusing on stocks that are cheap in terms of valuation and accept lower quality standard because of it. Okay, I see so many people saying, oh, this stock is great, look how cheap it is, the price declined so much and the stock is profitable, the company makes profit, the company is a giant, okay? They are giants, maybe the profit will grow faster in the future or the profit will come back on a growing trend in the future, okay? Here I have a few examples, Danone, Teleperformance for French people, Intel or Total Energy. For example, Total Energy, when you compare it to American majors, it's cheap. But the company doesn't have really something more. Same for Teleperformance. You look at Teleperformance, great company. Okay, if you look at it, you have the total revenue, beautiful growth for the total revenue. Okay, you have the net income, like fine growth for the net income. They grew more the revenues than the net income, but on some metrics, it's not this. It's not this. I'm sorry, but look. You have PE ratio of 11, so super cheap stock. Okay, forward PE of 6, extremely cheap stock. I think we can all say this. But then you look at the debt to equity, 110%. In my opinion, if it's over 70%, start to be not good. EBIT on interest expense, 4.3. Okay, the average in the S&P 500 is 10. Okay, it's a French stock, it's not in the S&P 500, but yet you need to understand that the average is 10. Here, 4.3. How do you want to outperform the S&P 500 if you don't have better companies that you have in S&P 500? Here, the return on invested capital only 9%. Return on capital employed 14%. Operating margin barely 11%. Okay, so that's problematic. That's things that I don't like to see. I want to have all of this. Operating margin, I want it over 15%. Return on invested capital, I want it over 15%. EBIT on interest import, I want it over 8 or 10. Debt to equity under 70%. Of course, yes, you have a dividend yield of 4.1%, but still, okay, don't get down, don't put the quality down just because the valuation is extremely attractive. And I'm not sure that this kind of stock, you will be comfortable with keeping them for at least 10 years. Like 10 years, you close Interactive Broker, you close a Robinhood or whatever you're using. I'm not sure you will be comfortable knowing that your money that you worked hard to save, to have, that you will feel comfortable with this. So avoid going on cheap company just because they were giant, just because they are very well placed on the market. You want company that have a good quality, that have good numbers, that have good moat, and so on. Okay? Mistake number 3 that I see a lot is trying to time the market. I think this is the worst one, the most common one, because it's our human nature. Even me sometimes, I don't know, I feel my brain trying to time the market and so on. You have this, the stock is declining too much. A lot of people saying, I'm waiting for the storm to pass and then I will start investing. Those same people, when the stock will take 30%, I guess when the stock takes 30%, the storm is out of the picture now. They will say, oh, it took 30% a few months ago, a few years ago, it was 30% less. So I'm waiting for the price to come back 30% down to the price that it was before, because now it's overvalued. So if you're not able to buy when it's cheap and now you're not able to buy after 30%, like what are you expecting? You're expecting to have plus 5% and be on the good moment when it will be plus 5%? Like, come on, no, it's not possible and nobody is able to do this. Here what Monish Pabrai, the best Indian investor, said, volatility is friend of long-term investor. So embrace volatility, accept that on the short term, the market can go down, the stock can go down. It doesn't mean it's a shitty stock, it just means that for now, apparently, the market is not appreciating it, especially if it's a good company stock, okay? Mistake number 4 that I can see a lot is following the crowd. Here, it's nothing new. I'm sure you already heard it. Don't start investing in stock because you saw it in the news, because a friend, a colleague, somebody start talking about it. If you have people online or wherever like to talk a lot about this stock, it's the opportunity. Like it's not a reason to go, especially if the stock already took 50, 60, 100%. So don't get into those big crowd things. Okay, don't follow the crowd. You've seen, for example, the things that I see a lot, like you've seen Nvidia, it's the future. I think it's good to invest because Nvidia has super nice chips for AI. But guess what? As Howard Marks says, a lot trees doesn't grow to the sky. Okay, so be careful with it. If you feel that everybody around you really think it's the best investment to do right now, it's probably not a good time to enter, and it's probably time, if you have it in your portfolio, to sell or to accept that, no, I should wait. You may look like a fool for sometimes. You need to accept that you will look like a fool for sometimes, but at the end of the day, I'm sure on the long run, you will feel good about it. For example, everybody that avoided in 2000 the tech stocks, the internet bubble, everybody that avoided them, yes, it was difficult. They were looking like fools when you had your somebody working in your garden which was making like few thousand, few tens of thousand, few hundreds of thousand on some tech stock, and you were making zero. But at the end of the day, 3 years after, I think your portfolio was way better. 5 years after, 10 years after, way better than the portfolio of this person. So be careful of this, of following the crowd, really. And the best way to avoid those mistakes is to follow those 3 paths. Okay, the first one, only invest in company with good numbers. Okay, that's the only things that matter. You have a study, I don't remember who published this study, I think it was MSCI. If you take the MSCI World Index and you apply on it quality criteria, you have outperformance of the index, okay? So what kind of quality criteria you can add? I like return on invested capital over 15%, or return on equity, return on capital employed. Look at the three. Generally, I use return on invested capital over 15%. You want operating margin over 15%, even over 20% if you can. Like this, the higher it is, the better it is, to be fair. Then you want the revenue to be growing. You want EPS to grow faster than the market. And again, it's okay if during 1 or 2 years you don't have revenue growing, as long as you have all of this good. You can look, for example, at Meta, which was probably one of the best opportunity when it comes to all those things, like generational opportunities. Like Meta was one of the best of this. If you go into the financials, in 2022, you had some, it got calm a bit, you see. 2022, the revenue didn't increase. We had a little recession, but nobody talked about it. But there was a very, very little recession for 6 months. The net income, okay, it decreased. It decreased during this period. But if you look at the other metrics, the other ratio, if you want to look at, I will put this out, you can look at the margins. Operating margins, 2021, 2022, almost 30% decreased, and then go back to the norm. It totally decreased, but it was 30% margin. Like it's huge. It wasn't a 10% or 5%. The company didn't stop to be profitable. It was still huge profitability. If you go on a return on invested capital during this period, return on invested capital in 2022, it went to 21%. And everybody was saying Mark Zuckerberg is a totally fool, he lost his mind, he's stupid with the money of investor and so on. But yet the return on invested capital was still 21%. Okay? In the return on equity, 18%. Okay? Return on capital employed, 22%. It was less than it was at almost a moment during the, historically, but it was still higher than what the S&P 500 can give you. When it comes to debt, okay, remember, if you don't have debt, you cannot go bankrupt, because going bankrupt means you cannot pay the people who you have to pay the debt to. So if you look at the debt, okay, debt to equity, 20%. Ridiculous, extremely slow. Debt to EBITDA, minus 0.3. They had more cash than they had debt. EBIT on interest expense, 181. Okay? So we're far away from being a bad company. It was a bad period, I agree. It was like the revenue declined a bit, like was stable. The net income declined. So yes, it was a bad period, but the numbers were great, okay? And then, as I said, net debt to EBITDA under 3. Second thing, you want strong moat. Even better if there is a growing moat. Same for Meta. You have a huge network effect. Network effect is one of the best moats they have. Here is a study from Morningstar. You can see the top performer, and generally network effect is always in the top performer. It's one of the best moats that can exist, okay? And Meta have a huge network effect moat. So you want company with strong moat. So the 5 main moats that you will see generally is switching cost, network effect, intangible assets, cost advantage, efficient scale. So have a look. Does the company that you want to invest in have one or multiple of those moats? Is it strong and is it growing? Okay, a growing moat. A lot of people just focus on company with a strong moat, big moat that cannot be touched. But a company with a growing moat will outperform everything. If the moat is growing, this is the best type of business that you can invest in. And lastly, you want good value. Yes, great numbers, great moat, but you want to buy at a good price. Here's a study from Schroeder. It's in the UK, I think, with MSCI UK. So you have in blue MSCI UK. In blue, dark blue, you have MSCI UK, but with a quality factor. And then in green, with quality plus but at reasonable price, but which is when it's not overvalued. And you can see that it totally crushed it. Like it totally outperformed everything since the 90s. Okay, so you want to have good value. At least you need to expect 13% growth per year with conservative expectation about growth. When I say 13% growth is a 13% cumulative annual growth rate for your stock, for the price of the stock, and with low expectation in EPS growth. For example, if the expectation of EPS growth would be 15% per year, you will put 12%, 11% to be very conservative about it. And here is how you can find some great deal, okay? The best way to have good value is to be contrarian and buy great companies when nobody wants them. If you can find some companies that absolutely nobody wants but have super great numbers like you had here with Meta, okay? If you can find this, like your portfolio will say thank you to you and you will have a great performance, okay? So that's all for this video. Let me know in comment section if you'd like a video with 3 stocks that fit the 3 criteria that we saw here and that seem to be undervalued, that seem to be good for a contrarian portfolio. So let me know in the comment section. See you soon.